Gold holds steady at 3-week lows despite US bond yields rising. BOE raises rates to 15-year high. Gold prices remained steady after hitting a 3-week low with hot US job data and the US Treasury boosting the size of its quarterly bond sales as the US credit rating was downgraded, while the Bank of England raised interest rate to a fresh 15-year high, writes Atsuko Whitehouse at BullionVault. The Bank of England opted for a 25 basis point hike to interest rates, which took the main rate to 5.25%, the 14th increase in a row, but slowing the pace of increases from June's 50 basis point rise. Gold priced in pounds per ounce rose 0.5% to £1,530, while gold prices in euro edged higher by 0.1% to €1,770. If CPI inflation is expected to fall significantly further, to around 5% by the end of the year, accounted for by lower energy, and to a lesser degree, food and core goods price inflation, said the minutes of the bank's meeting, adding that it will meet its 2% target by early 2025. Headline consumer price inflation in the UK slid to 7.9% in June from 8.7% in May, while data from the British Retail Consortium on Tuesday showed annual shop price inflation cooling to 7.6% in July from 8.4% in June for the first time in 2 years in month-on-month terms. Gold prices in the US dollar meanwhile held near 3-week lows at $1,936 per ounce on Thursday morning as higher yields and a stronger US dollar weighed on the yellow metal. U.S. private payrolls data on Wednesday and the U.S. Treasury boosted the size of its quarterly sale of longer-term debt for the first time in more than 2.5 years as the U.S. credit rating was downgraded on Tuesday. Government debt in the U.S. increased to $32.6 trillion as of today, according to fiscal data site created by the Department of Treasury and the Bureau of the Fiscal Service. The size of debt jumped in June 2023 after lawmakers voted to suspend the ceiling of $31.4 trillion until January 2025. The Treasury said on Wednesday it would sell $103 billion of longer-term securities at its so-called quarterly refunding auctions next week. With larger auctions confirmed for the coming quarter, the sell-off has extended, BMO capital markets strategist Benjamin Jeffrey said in a note. 10-year U.S. Treasury yields, a benchmark rate for government as well as many finance and commercial borrowing, jumped 10 basis points as prices of treasuries dropped in wake of the refunding release. The benchmark yields continued to rise on Thursday to 4.15%, the highest since November 2022, which pushed the dollar index, a measure of the U.S. currency's value versus its major peers, to a 4-week peak. The question from here is if investors will be willing to buy the dip ahead of payrolls data released on Friday, or if the sell-off has room to extend, Jeffrey added amid debate on the appropriate discount for longer-term debt. Overall, the U.S. has a debt problem, but that unfortunately gets lost in the politic. Luckily markets have the ability to look through, tweeted Nikki Shields, head of metal strategy at Swiss refining and finance group MKS PAMP, comparing market reactions of the previous U.S. debt downgrade in 2011, when the U.S. yields fell, while gold spiked over $400 in 2 weeks. Fitch, a top rating agency, cut the U.S. debt rating from AAA to AA+ late on Tuesday. It was only the second time in history that a leading credit agency downgraded U.S. debt. The first was in 2011, when Standard & Poor's cut the US AAA rating after a nerve-wracking fight between the Republican and the Obama administration over the federal budget. The rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA-rated peers over the last 2 decades, Fitch said. Richard Francis, a senior director at Fitch Ratings, told Reuters on Wednesday that Fitch downgraded the U.S. credit rating due to fiscal concerns, a deterioration in U.S. governance, as well as political polarization reflected partly by the January 6 insurrection. European stocks hit a 3-week low on Thursday, as the pan-European Stoxx 600 index fell 0.9%, its third consecutive day of losses. US stock futures signaled further weakness after the worst session in 3 months for the S&P 500, slipping 1.4% last session, while the Nasdaq 100 slid 2.2%. Ahead of the key U.S. job data published by the U.S. Bureau of Labor Statistics tomorrow, U.S. private payroll data, by Automatic Data Processing Incorporated, ADP, revealed on Wednesday that the number of employed people in the U.S. rose by 324,000 in July, higher than the 189,000 expected increase but lower than the revised figure of 455,000 for June. This raised some doubt as to whether the Fed will pause at its next FOMC meeting, said Daniel Hines, senior commodity strategist at ANZ.